What we are looking to do today is cover accounting for a buyout. And what we're looking at when we're talking about a buyout is not an offsite catering event, but when somebody wants to come and uh, basically rent your restaurant for a night. If you're not familiar with prefix accounting, we are a full service bookkeeping and payroll firm. We also do consulting and advisory. It's really the bread and butter of our business. Um, and we do this, we offer this service exclusively to restaurants, specifically independent restaurants in small groups. We don't work with franchises or anything like that. We're looking more at dealing with more upscale full service restaurants, though we do quick service and limited service as well. This presentation today is meant for operators, not CPAs, so there's no tax advice or tax guidance here. This is really looking at operational advice for how to set up and execute buyouts for the restaurant in a way that is easy for operators to deal with and also makes your accounting easier. Uh, Also worth noting that this is not for catering. So this is not for any sort of event that you're doing offsite. This is purely meant for something that is within your four walls of your restaurant. And with all of our webinars, we do have this disclosure that this is not legal or tax advice. The information in this webinar has been prepared for informational purposes only. If you are interested in more of our content, feel free to subscribe on the link here. We will be sending out this webinar afterwards and the slide deck as well, so that you can utilize this link that you have here in order to see what we have coming up and any sort of other topics that are of interest to you. You can also subscribe to our newsletter, which will give you any notifications every time we schedule new webinars that you're free to go ahead and register for as well. Looking at an overview of what we'll be talking about today. Excuse me. We're going to be looking at revenue recognition, which is basically the difference between cash versus accrual and what that means for your reporting. We'll also be looking at pricing, which is probably the biggest thing that is difficult with any sort of buyout. There's a lot of economics associated with it, and it's less about what you're serving and more about what type of money you should be making. We'll also touch on contracts and making sure that we have a couple of provisions in there that will help you for when you are hosting these events. We'll go over creating an invoice, dealing with event deposits, settling up after the event, and then optimizing these buyouts for cash flow if you have a seasonal business. So first things first, revenue recognition. There's two different methods two different accounting methods that are utilized here. One is accrual, which is where revenue is counted on the day of the event. So the day that happens, not the day that you took the money in. Deposits will show as a liability on your balance sheet until the day of the event, and the accounts receivable is dated for the event. With cash, it's the opposite. So revenue is counted when money is collected. So the day that you took a check or an ACH or a wire, that is the day that that money is counted. And deposits are revenue. An account receivable doesn't, the dating doesn't matter. It's purely based off of when money comes in and money goes out. That's on a very high level, but the breakdown of the differences between the two. Why this is important is because when you're looking at your financial statements, it is much easier for you to see revenue with an accrual model than it is with a cash model. And there's a lot of restaurants out there that will operate on the cash model, but it's not necessary. It is definitely not the best way to do accounting for restaurants. Accrual model is completely superior in terms of understanding your costs and capturing your costs on a weekly basis, and analyzing those financials year over year. Whereas cash basis definitely does not help you in any way, shape, or form, other than it's just slightly easier for some people to understand. If you're not sure what your accounting is set up, or how your accounting is set up, or reporting is set up in QuickBooks Online, if you go into QuickBooks Online, in the top right hand side, there's a gear icon. If you go to the gear icon and then you go to settings and then go to I believe the first tab will actually have this little snippet right here, which says what your accounting method is. And it'll say accrual or cash. And then on your tax return, depending on what tax return you have, all of these tax returns will have this item right here that will say what your accounting method is. These two things should match. If they don't, you should check with your CPA as to why they don't, or your tax preparer or your bookkeeper as to why these two numbers don't, or these two settings don't match, because they definitely should. The nice thing about QuickBooks is that, or QuickBooks Online, is that you can switch your reporting to cash or accrual, even though your accounting method is the opposite. So if you're on cash basis, but you realize now that you really want to look at this and on an accrual basis, you can set your reporting in QuickBooks to report on an accrual basis. The one thing of note with that is that if you don't point this out to your CPA, they may not notice that. So it is definitely worth noting that to your CPA, when they're preparing your tax returns, that the reporting is currently configured for accrual or cash. So the biggest thing for today is the pricing. And I think this is the part that most restaurateurs struggle with. Pricing is difficult with buyouts, because it's not just a matter of like what you're serving and how many people you have. There's an opportunity cost that you have to factor into this. So a restaurant on a Friday night may pull in $15,000, and somebody may come to you and say that they want to do a buyout on that Friday night. And it's maybe a 20-person buyout, and they only want like a 3-course prefix meal. 20 people, 3-course prefix meal, and some beverage is not going to hit that $15,000 mark. So you should not be doing that buyout. And especially if they want to do a complete buyout, what you should be doing is trying to steer these clients in a different direction. First of all, if you are doing a buyout on a Friday night, you have to make it worthwhile for you. If you're typically pulling in 15K, you should be pulling in more than 15K for you to be able to want to close your restaurant off to the public. The reason that is because there are additional costs associated with closing the restaurant on a Friday night. You're denying your normal customer base that returns to you day over day, and this buyout is a one-time deal. And B, walk-ins really hate it when the restaurant is closed on a night that they definitely should not be closed. Obviously, you may put that on social media, you may send out an email blast, so on and so forth. But at the end of the day, people don't check. So they show up and then they see that the event or the space is closed for that night, and that pisses them off. It's just a fact of the matter. So if you are irritating your client base, there has to be a premium that you have to charge in order to be able to make it worthwhile. So most folks will suggest that there is a 10 to 20% premium on top of what you normally do that night. Now, this isn't to say that you are going to make your buyout minimum, you know, $18,000 on a February Friday night, especially if you're in a rural environment like we are. You have to look at what you normally do on that night of business and then make a calculation based off of that. If you're pulling in $15,000 in July, your buyout premium should totally be $18,000. However, if it is in February or it's in March or April, which in our area is basically a ghost town, that's a very different number. And you frankly probably want to bring in that business. So make sure that you're also looking at what your normal, make sure you're also bringing in what your normal, looking at what your normal nightly take is for that time of year. If you don't have the other thing worth noting here is that if there is a somebody that wants a buyout and they don't want to pay the total premium price, you have to steer them in other directions. There's a couple of different options for you there. One of them is to steer them in the direction of uh, um, a partial buyout or moving them to another night that is not as busy. So like a Wednesday or Thursday night, or even a night that you're not normally open. So those are the ways that you kind of have to steer your guests. If you don't have the facilities to do a partial buyout, don't do a partial buyout. It doesn't go well. It always is disruptive to have a partial buyout in the same space as a full as the restaurant itself. It is it's just something that's inadvisable. If you have the ability to to have an actual PDR space, it's a worthwhile investment for you to build out that PDR space and make it private. You will probably sell it out quite a bit, and especially if you're doing quite a bit of buyout business, that allows you the ability to continue to do buyout business without having to close the restaurant. So one of the things that's the biggest concern for buyouts is beverage pricing. Food pricing is fairly straightforward. It's the same application that you're doing for catering. You're utilizing the same kind of markups. You're doing the same kind of pricing model. You are doing the same. You're probably pulling directly off of the menu for many things. Prefix menu, buffet menu, family style. You may have a cheese board or two, but all of that is pretty straightforward. It's not really worth mentioning here. The thing that is worth mentioning is beverage pricing, because there's a lot of different options out there for how you can actually do this, and some of them, and they're all situational. So you have to be kind of careful with the model that you want to use, and you shouldn't necessarily subscribe to one model or the other all of the time. It's the 80-20 model where you're maybe utilizing by consumption all of the time, 80% of the time, and then switch out in a couple of different places. If you are hosting maybe a kid's birthday party, by consumption is probably not the way you want to go. It's probably by head by hour. However, if you are hosting a frat parties mixer, by consumption is definitely probably the way to go, or by inventory. Probably don't suggest doing a frat parties mixer in general from a liability perspective. So there's 4 different models here, really. There are others, but for the most part, these are the big 4. There's by consumption, by head, by hour. By inventory or cash bar. By consumption, patrons order whatever they want. Servers log all of the beverages purchased and then settle up at the end of the night. There's a minimum that is minimum threshold that they need to hit. If they are under that minimum threshold, then they're charged the minimum rather than what the actual consumption was. By head by hour, you come up with a fixed hourly rate that is per person per hour. And then an additional charge for every hour beyond that per person. This is good. This is a very simple model. There is also a minimum that you want to do here as well. By inventory is purchasing a set amount of inventory, utilizing that inventory for the event, and then when it's gone, it's gone. And then finally, the least popular option for all guests of buyouts is a cash bar, which is basically all of the guests pay for their own beverages and everyone is sad. So getting deeper into these different sections, buy consumption is by and large the option that most folks probably want to go with. The it is the most accurate. It's the easiest to deal with, and it hedges your bets the most easily, because regardless of what they consume, you're getting paid for it. With all of the other options, there is some downside to it in terms of you not hitting certain thresholds. The con to this is that if there is a significant amount of consumption on that evening, then the final balance tally at the end of the night could be a significant amount. And if it is a significant amount, that could run into problems with your guests being able to pay for it. That's really the biggest downside that you have with that. The there should be a minimum that you have for these charges though, because if it's by consumption and you are hosting a kid's birthday party, they're probably not getting too much into the sauce. And so if you are trying to get them to that sweet spot of like $18,000 in revenue for it to be worthwhile, then you basically have to back into your minimum, where you're going to, the minimum is a little bit less than that threshold that you're looking for. So if they don't buy a lot, you're still going to come in somewhat close to what you normally would have made. And so that's where there's a little bit of wishy-washiness with this, because you definitely want to have that minimum on here. Otherwise, if they don't drink at all, then you're going to fall seriously short of where you should have in terms of consumption and your revenue amount. By head by hour is I'll say is probably a more traditional old school model that is becoming less and less common. Essentially, when you come up with that rate, it's a very simple process. It's very easy to calculate. It does have that going for it. However, if there is overconsumption and it's a feeding frenzy, you will lose your shirt on this, and there's liability issues with that, and you could very well run out. The other thing with this is that you also have to include tiers in this, because, or a select menu. If you have this base rate per person per hour, and everybody is reaching for the top shelf, then you are definitely going to lose your shirt on it. So if you have a tiered model where there are certain things available to folks, certain things that are not, you remove those certain things that are not available from the bar so people don't even see that they're available, that hedges your bets to some degree. You can also bring in some specific uh, types. So you could go with beer or wine only. And that also kind of hedges your bets a little bit. Buy inventory is kind of an interesting one. It does have quite a bit of pros and cons, but in the right application, it is useful. You buy a specific amount of alcohol, and once it's gone, it's gone. Pretty straightforward. It's easy for operators and guests to understand. You don't have to explain to them what minimums are and what the consumption amount is and why and what things they have available to them. They know exactly what's available to them. They know exactly how much they have, and it's easy for them to understand what it's going to cost them. If it's by consumption, they don't really know how much it's going to cost them. You know, if grandma gets into the schnapps and really hits the sauce hard, like, she's running up a significant bill. But here, with a specific buy inventory amount, like, once it's gone, that's really the end of it. The downside to this is that if you order incorrectly, you may run out quickly, and then you're standing there looking kind of like an idiot because you don't have anything, and that tends to piss guests off. So you have to be careful with what you're ordering is. Also, if they want a full bar, probably not a great option, because you would have the amount of inventory you would have to buy in order to stock a full bar isn't really viable. The other thing that you can do with this is, you know, there are guests that are out there that perhaps want a specific thing. So they may be, beer snobs, and they really want a couple of different IPAs, and you're fine dining, you don't really sell a lot of beer. It's hard for you to sell through that much beer. You know, you can add buyback provisions into this. So if they want a specific wine that you're never going to put on your wine list, that's a good option here. Is like, you buy, 3 cases of this specific wine that the mother-in-law really wants, and you're never going to put Barefoot Riesling on your wine list. You can turn around and say, okay, I will buy 3 cases of Barefoot Riesling for you. If we don't sell it all, I'll sell it back to you at cost. That way, you're not stuck with trying to figure out what to do with 3 cases of wine that you don't want, or 3 kegs of IPA that you're not going to be able to sell through, and you're going to have to get rid of somehow. The final option here is the cash bar, which most of us are pretty familiar with, so I'm not going to get too deep into it, but you don't have to worry too much about over serving. And also, so that is a good thing in certain situations where you might be worried that they may drink too much, or over serving. The downside to this is that it's also usually pretty low in terms of revenue. Once people find out that it's a cash bar, then it comes down to, oh, I don't have any cash on me. I didn't think everybody's always surprised by the fact that it's a cash bar. So you can normally anticipate that it's probably not going to be a very busy bar. The other thing worth mentioning here that isn't necessarily revenue, but is in the pricing arena, is what the norm is for billing gratuity. This is a tricky subject, and it's one where communication is key in terms of setting expectations. It is worthwhile to make sure that you include 20% gratuity on the food and beverage minimum of the invoice that you initially send out, and then clarify to them, if it's by consumption, which probably most folks are going to be, that if it's by consumption, there is an additional gratuity required for the consumption balance. So if they hit their minimum, they're $1,500 over their minimum, they have to pay a 20% gratuity, or they have to pay a gratuity on that consumption over the minimum. It is important to clarify that, because if they don't necessarily know that, they may not be restaurant people. They may never have done a buyout before in their life. They may have no idea why they're paying so much money to begin with. If you ever Google restaurant buyout, it's filled with comments about people just like completely confused about why they're paying X number of dollars when they thought it would be super cheap to rent out your restaurant for a day. Which is just a ridiculous notion. But if you clarify that to them, then they know that. If they're confused by this whole process, they're going to assume that that 20% gratuity that you invoice them for already covers everything over that in the final balance. So it's really important to verbally say it, not just put it in the contract, but verbally say it to them and reiterate it to them multiple times. Otherwise, it may not sink in. And for a lot of folks, this is a new experience for them. They probably only retain 50% of what you say. So say it a couple of times. Especially if you don't have beverage minimums in here, this number can be the tip, if you don't include it, is going to be significant. So putting it in the invoice ahead of time kind of hedges your bets. So now that we've touched on what the total income number should be, it's now time to kind of look at what we should be doing from an accounting perspective for your contracts. The first thing is, do not use a Rocket Lawyer contract that you got off of the internet for $20. I will say this again. Do not get a boilerplate legal agreement for a buyout contract. Pay the money for a lawyer that works in the restaurant industry, that is used to building out these contracts, that already has a great contract that is specifically catered for restaurant buyouts ahead of time. And then it's just a little bit of fine tuning. Yes, Rocket Lawyer costs you $20. Yes, this lawyer probably will cost you $400. However, the $20 legal agreement that you got online is not going to protect you when it comes to any sort of issues with the contract. Specifically, if you have something like COVID, where somebody has COVID, or there is a worldwide epidemic that comes out and suddenly everybody wants their deposits back. If you use the Rocket Lawyer agreement or the Rocket Law agreement, you're probably handing those deposits back. If you're using a well thought out legal agreement, there are provisions in there that is going to prevent you from having to give those deposits back, and instead are going to require your guests to choose a different date further on down the road, so you don't have to cough that money back up. So what this agreement should cover from an accounting perspective, your lawyer is probably going to have a number of different other agreements that or provisions that they're going to want to include in this, is payment and deposit schedule, when that payment is, that the final payment is due, when the deposit is due, if that is a deposit at all, how the fees are calculated, what the method of payment is. You probably don't want to take an Amex for a $20,000 restaurant buyout, because that's going to be an exorbitant amount of money in credit card fees. Instead, you may want to take a wire or an ACH or a check. Putting in when the final menu date is, so that they can't come to you 3 days before the event and say, you know, grandma really, really wants a mint aspic crudité, whatever the hell that would be. But the last thing that you want is for somebody to come in at the last moment and change what the menu is and cause you to have to run out to the store to grab all the ingredients so that you can have grandma's crudité. Also, mint aspic crudité sounds absolutely awful. Same thing, final rental date. If you do have to do rentals, which for buyouts, it's kind of few and far between, but um, if there are rentals that you have to do, like they really want a specific set of plateware or something like that, a final rental date that is more in advance so that you can reach out to the rental company and make sure that they are able to stock it. This is the big one that a lot of folks were missing last year or last year in 2019, 2020. And a lot of folks also had these agreements, but they didn't cover all the acts of God. An act of God is essentially something that is completely unexpected, that you have no control over, that forces you to not be able to render services. And so what that is essentially is, say there was your event is for today, right? And last night there was a tornado, and the tornado knocked a tree over and sent it straight through your restaurant. That is an act of God. There is no reasonable person on earth is going to assume that you are going to be open up for service that evening. So there needs to be a provision in there for COVID, worldwide epidemic, trees falling through your house, through your restaurant, a propane tank exploding, fire, any of these things. And what is going to happen with those acts of God? If it is something that is remediable, so essentially you get the building fixed, you can do this event at a later date. Great. Otherwise, if there isn't remediable, like the restaurant caught on fire, how you're going to resolve that. All of those things have to be in there. And this is probably one of the most important things in the agreement. Also, how does moving a date work? Who agrees to what date is going to be utilized? Does the price change if you have to change the date? Are you going to eat the cost if they have a event in April and you have to change the event to July? That price, or what we should be charging, should change if this was a normal case. But are you going to have it keep at the same cost, or is that cost going to change? There's no real wrong answers here. It's all dependent on what kind of service that you want to provide them, or if you want to make sure that you're getting every dollar that you possibly can. But the big thing here is that you want to have it all spelled out so that there are no surprises. Finally, how a tip or gratuity is charged, and then what a non-refundable booking fee looks like. And when I say fee, I mean fee. So if you have somebody that is booking a date and they are going to, they want the date to be taken off of the menu, they're going to do off of the calendar, they're going to definitely book for that day. You, in a traditional sense, pre-2020, people would say take a booking deposit. So if there was a cancellation, they would give that money back. Most people realized very quickly during COVID that a deposit was not going to be a good idea, because they already put a bunch of work into this. They already did a lot of communication, a lot of footwork. They did a lot of showings. They've already done a considerable amount of work before the event even comes to pass. And now they're not being compensated at all for that amount of work. So most folks have now switched to a booking fee where there is a set dollar amount in order to book. Okay. So it might be $2,000, it might be $1,000, it might be 50%, depending on how significant the restaurant is and what the demand looks like. Um, but taking that dollar amount and making sure that the language is fee rather than deposit means that you do not have to give that money back. So the next item here is looking at setting up reporting and creating an invoice. The biggest thing here is that buyout income accounts should buyout income shouldn't have its own accounts. So with catering, you have your own chart of accounts that you are utilizing because it's offsite revenue. For a buyout, you don't want to do that because you want to be able to look at year over year what your income was for a specific week or month. If that is in a different income account, then it's very hard for you to be able to do those comparatives. And you have a void. So if it's normal restaurant income and you are closed on a Tuesday or closed on a Friday, and there's zero income there for that Friday, but there was a buyout for that day. It skews your financials so that it looks like the restaurant was not performing as well as it actually was. So you want to make sure that you're including that buyout income in your normal restaurant income accounts. If you do have any sort of fees that are not part of normal restaurant operations, you want to split that out from your income accounts that you currently have. So if you do rental fees or something like that, you don't want to lump that in with like food income or anything like that. That you do want to segment out. But your normal food income from that event, beverage income, all of those things you want to allocate to your normal restaurant accounts. You will want to go into your point of sale and create a separate sales category for your point of sale so that if there is an event that you're doing, you can turn that the open items on and off, because you may have separate pricing, you may have open items in there, you may have any number of things that you don't necessarily want your servers to have access to around the time of that event. So you don't want people utilizing open food when they're not supposed to, and charging the wrong price. So when we are creating products for an invoice, we have the same accounts that we're utilizing. However, for most people, we are also going to have different products in QuickBooks. And what products are in QuickBooks is basically a way of masking account names to include so that people aren't seeing, restaurant food income. Like it allows you to have a different naming convention for something that is mapped to that account. So in this case, what we're looking at here is an example of catering, a product that is catering food that is mapped to catering food. In our case, what we want to do is probably buyout food or buyout prefix menu or something like that is mapped to restaurant food income. What you do not want to do here is create a new product for every single menu item that you have here. So if you have a buyout that is a prefix menu and they are having a wintergreen salad, short ribs, and then a panna cotta for dessert, you don't want to create, each of those items because eventually what's going to happen is you are going to have an absolute mess in QuickBooks with all of those products. What you want to do is you want to create a product for each sales group. So food income, beverage income, food income, wine income, liquor income, if you have it split out that well. Or in many cases, what you're going to have to do is do a percentage split and just call it beverage minimum. But you'll want to have a separate separate product for each sales category. And you don't want to add any products that are beyond that unless you're very commonly using it. So if one of the things that you do frequently for a buyout is, say, like a cheese board or something like that, like you have some sort of like grazing platter or something to that effect, then you may want to create a separate product for it. But if that's not changing, or if that's not the same every single time, don't add any accounts. So this is in the product section. So if you go to QuickBooks Online, you go to the gear icon in the upper right-hand corner, you're going to see a thing that says lists. If you go to lists, it'll bring you to products and services. Go to products and services, hit new, and then this page right here will pop up out of the right-hand side. You have a couple of different options that are here. A couple of different product details that are here. The naming. So this is what guests will see on the invoice. So you want this to be something that is will be seen on the invoice. The category you want to probably split out into buyout or something to that effect. And then once it's grouped together in that category, it's very easy for you to see all that information. Sales price and rate you want to keep blank unless it's the same all of the time or like a certain market rate. I would go ahead and do that. And then also your income account is going to be the matching restaurant income account. Finally, taxable. Only make things that are taxable all the time taxable. Now, when we're actually going and creating this invoice, we're going to go to the new icon, go back to your normal homepage in QuickBooks Online. In the upper left-hand corner, you'll see new, and then you are going to go ahead and hit invoice. It'll bring up a page that looks very much like this. And here is an example of a catering invoice that is similar to what we would be doing for a buyout. And so as we're completing this information, we're going to want to complete a couple of fields that are going to be super useful for you in the future. The first is QuickBooks payments. So that's these little icons that are right here in the center of the page. QuickBooks payments is a product that Intuit offers that allows you to collect payments via ACH or credit card directly within the invoice that you send out. I highly recommend it, specifically if you're going to be doing a lot of invoicing for buyouts or catering. It's very much so worthwhile. And as you can see here, you can choose what payments you want to be able to, or payment types you want to be able to offer. So you can allow them to use a credit card if you so choose, bank transfer, and ACH, and you can even have them be able to add a tip on top of the tip minimum. Next, you have event location, you have guest count. And so these two are useful for you to, when you're looking back on, on invoices, to use for invoices in the future. So the guest count, obvious, it's easy for you to then look and see, this is a 20 guest count. We're going to do price per head for folks. We're going to map, there are going to be certain things that are going to be mapped out for that. And then the event location, if it's a partial buyout, if it's a full buyout, if you have outdoor space, is it out in the outdoor space? And then if you have an event coordinator or somebody that is booking the event, who is responsible for this event? Once you have all that detail, then you really will start to build a good record of practices that you're going to use. A couple of differences that you are going to see here on this catering invoice that you're not necessarily going to include on your buyout. As you can see here, we have food, obviously, and then we have that the different things broken out here in terms of what things are going to be served. So you utilize the description for the detail on what is actually going to be served, rather than creating a specific product for it and gumming up your product list. You also can then list out what the rates are going to be, and the quantity of folks, again tying back to the guest count, and it will start to subtotal everything for you and then calculate the tax as well. Things that are not going to be included in this are probably there's not going to be any labor. With buyouts, it is not normal for you to include labor in these invoices. You can sometimes, if they have specific requests that go above and beyond your normal operation, like if they want very specific things, like if they wanted to have like an oyster bar or something like that, and you have to bring in an outside contractor for it, that is a good example of times when you would want to bill them directly for that, because they're choosing that, and that's not something you normally do. You also have a good amount of, you could have an admin fee that is applied to this that factors in your costs for programming the event, or if you're doing rentals, but that is not necessarily a normal practice as well. You will want to set up if you are on accrual, you'll want to make sure that your invoice day is the day of the event. And then if your cash set if your cash basis, then set the date of the invoice and due date to the final day of the payment is due. With deposits, this is one of the areas that I find that QuickBooks is particularly painful and does not handle well. There is a deposit section that you probably saw on that window that we were just on. That is not a good, that doesn't work well. Doesn't work well at all. You're going to want to create a product that is called event deposit, and it affects your catering or event deposit liability account. If you don't have that account, you're going to want that account. You're going to send the invoice with only that product, with the deposit amount set for the day of the deposit is due. You modify the original invoice after you're paid, and then adding a line for the catering deposit product with a negative amount for what they have paid. That will net the final invoice, or the invoice, to be the correct amount for the balance that is due on the final week before the event. You will definitely want to keep a spreadsheet that keeps track of all of this, because that account or event deposit on your balance sheet is quite messy, especially if you're doing it at volume. If you only have 1 or 2 a year, then you're probably okay. On the night of the buyout, you're going to want to, it's pretty straightforward. You're basically going to want to look at what your total consumption was by pulling up the tab that all of your bartenders have been ringing through. You're going to, if they've hit that minimum, then you're going to net it out to be the balance due beyond that with a discount. So that's where it gets a little bit tricky. And you are going to then collect payment and ask them what they want to leave for the additional gratuity. Some systems will allow you to take ACH, but most people have to take it via credit card. It's also worth noting that if you are collecting tips for this event, please do not pay them out via cash at the end of the night. Collect the tips, pay it through payroll. And also make sure that tips from buyouts and events are included in your tip spreadsheet. It's very easy to forget that. Deposit timing. So this is one of the areas where you can utilize, you can take some, you'll have some advantages in timing so that it helps with your off season. If you are taking event bookings, you want to take a 50% deposit ahead of time, or a 25% deposit ahead of time, in addition to your event booking. You're going to want to make sure that that lines up well with where your low season is. That way you're taking in deposits when you're not taking a lot of regular business, and it helps you with cash flow through the winter months. With buyouts, it's a little bit trickier sometimes, because usually the window in which the event is planned is much smaller than, say, an offsite event where that might be done a year in advance. Most times buyouts are done 6 months in advance, but if you take that buyout 6 months in advance and it's in the summer, the event is in the summer, then you can take that deposit through the winter. Just be conscious of the fact that it is a deposit, and if something happens, you may have to give that money back. If you are doing a sizable amount of buyouts, it is worth considering utilizing some third-party softwares that are more that are better set up for invoicing catering for catering and events. These are three different options that are pretty much the leaders in the space. Triple Seat is my personal favorite, but they'll help with buyouts and any sort of rentals, and they'll help you organize the whole process of buyouts. If you're not doing a lot of buyouts, or your buyouts are very streamlined and no frills, it's probably worth skipping these, just because you are going to be paying a significant amount. Each of these is going to cost you about $2,000 to $3,000 a year. But if you're doing a significant amount of business and you have a lot of variance in each of your buyouts, then it's worth helping you to organize them. Okay, so key takeaways for today. Pricing is paramount. It's the most important thing about buyouts, bar none. Like, what your price point is and making sure that you're not shooting yourself in the foot by taking a buyout is absolutely critical. If you have the ability to do partial buyouts and have PDRs, you definitely should do it, because that hedges the issue of whether or not you're making enough to cover the evening for you. Number two is get a lawyer. Get a real lawyer that not, I shouldn't say real lawyer, a lawyer that specializes in your industry. There are a lot of lawyers out there. They may do all sorts of different things, from real estate transactions to estate sales to business and corporate law, generalists essentially. Similarly, how there are generalist accountants and bookkeepers out there. Get a lawyer that knows what they're doing with restaurants and restaurant contracts. It will save, even if it costs you $500 or $1,000, if it saves you once from having to give back a booking fee, it is paid for itself. Which brings me to point number three: use booking fees. Booking fees are critical to making sure that you are compensated for the work that you have done, regardless of whether or not the event has come to pass. Make sure that you have changed all of your language from booking deposits to booking fees, so that you're getting compensated for that time. And also make sure that you have your lawyer review it. Number four, timing is everything. If you are taking on a number of deposits, making sure that those deposits line up with where you need money most will help significantly. Finally, if this is overwhelming, which I totally get help. Like, you can utilize other restaurants, or you can utilize services like ours to help you and get advice to making sure that you're setting your process up so that you are properly making the money that you deserve to make.